Hi, everybody. Welcome. We're going to have a nice chat up here with Steve and Sarah about the LP-GP relationship and overall trends. I'm thrilled to have these two rock stars with me up here. Sarah, I'm going to start with you. You've been an LP, you've been a GP, now you're a consultant. It's like the trifecta. Tell us a little bit about your career as an institutional investor as we get into this conversation.
Sure. So I started my career at Wellington Management Company. I actually started as an admin and figured out that I loved investing. Then I went to the state pension fund, Mass Prim, where I was deputy CIO, overseeing the investment of that pool of assets, which at the time was about $80 billion. And I often say that if you can get something done at a pension fund, you can get it done anywhere. And you're also given a tremendous amount of responsibility way earlier than you ever should. And so it was a great learning experience. I knew I wanted to get into endowment management, really refine my private market skills, went to Wellesley College, and then NEPC came knocking, and I was a client for 6 years, and it was an easy decision to come and rebuild our investment process.
Nice. And by the way, the CEO of Wellington, Jean Hines, also started her career as an admin at Wellington. So Wellington had some rock star admins. Steve, tell us a little bit about Alaska Permanent. You were there for, I think, 9 years?
9 years.
And now you're at Wafra. Tell us a little bit about your career and how you ended up at Wafra and what you're doing there.
Sure. Well, I started out like a lot of people in this room and in this building, I suppose. I started out in banking. Then I moved over to private equity at Credit Suisse First Boston, where I chased middle market buyouts for a long time. But the best job, and the one that you asked about, was probably the 9 years that I spent, which ended about a year and a half ago, 9 years in Alaska, working for the Alaska Permanent Fund, which is the state sovereign fund. It was about $45 billion when I joined in 2013. I think it's almost $80 billion now. And I had this sort of unique experience, certainly in my life, this unique experience of building an alternatives program with lots of capital to put to work and a really supportive board and a great team. So one of the things I worked on there was a seeding strategy that revolved around a platform we called Capital Constellation. And we hired, when I was at Alaska, Wafra to manage it. And that's how I ended up at Wafra. You can see the connection. It's been a great experience all along.
Now you're back in New York after Alaska. You'd have to be an outdoorsman to love living in Alaska like Steve did. So we learned that back in the green room. So let's talk about the LP-GP relationship. I think it's fair to say that it's never been so tested, given what's going on in the market. We saw today in the news that a $10 billion fund in the real estate space, Starwood, is having a really hard time with liquidity. Liquidity is a problem. Talk to us a little bit, Sarah, about, you've been on both sides of the fence. What's going on with the LP-GP relationship right now, and where are the tensions?
Well, a really eye-opening experience happened just a couple of months ago. I was at an event where a set of founders of portfolio companies, so entrepreneurs, and GPs and LPs were in the room together. And we had a really candid conversation about where the disconnect might be between LPs and GPs right now, because there is some tension. And I think GPs feel as though LPs just want liquidity because we're being greedy. And LPs think that GPs aren't providing liquidity because they're being greedy. And the reality is that we don't really may not understand the position that each other is in. So what came to bear that was very, very clear is that these were mostly venture GPs. The venture GPs really didn't understand that LPs have more going on in their portfolio than just a venture capital program, and that they were sort of shocked to hear that, oh, you have a governing body? Oh, you have other investments? Oh, you have 10% in cash? Are you crazy? And questions about like, oh, your liquidity needs are just to post returns. They're to support the operating budget of a university, to make sure that kids can go to college, or to support a hospital system so that they can care for the sick, or to pay benefits to retirees. And my mom is in the state pension fund system for Massachusetts. And so it's very, very clear how important these things are. And so the work that we're doing, I think, increasing that dialogue about the position that LPs are in and the purpose of our capital, because the purpose is tremendous and it's making the world go round, is really important. And then for LPs, really understanding that GPs maybe can't sell at a reasonable price. Or if they decide to take part of their stake off the table with a GP, that there's a signal that goes to the market along with that. A signal to the founder, a signal to others in the ecosystem that perhaps this might not be a good investment, and they need to be able to manage, their relationships. And so it is very complex, and I think really just being curious and asking about each other's positions is always better than assuming at face value that one party or another doesn't have the best intentions. This is a gnarly market. It's a little bit, it's not one that we've seen in a long time. And really anyone under the age of 38 hasn't lived through a full market cycle. So looking around the room, I think there's quite a few people under 38 in here. And so we're all being tested in ways that we haven't developed that muscle in many, many years.
Okay, if I was a reporter, I would write the headline, "This is a gnarly market." Steve, tell us about the legislative. Yeah, go ahead, please.
I think Sarah makes a great point, which is that it's always problematic if there is not a clear understanding among parties. GPs don't get LPs and vice versa. But the only thing worse than that is when they think they know what the other one's thinking and they really don't. So I think that getting to the truth under that requires a lot of questioning, and having been an LP and a GP, I learned a lot being an LP, and I think I rarely meet asset managers who have a full understanding of what that's like. You get a different perspective from that small group.
Okay, and since we're talking about tension, I'm going to ask a question to create a little tension on the stage. Steve, you are in the GP stakes business. LPs don't always love GP stakes. Make us the pitch for why GP stakes. I mean, you were an allocator, so I think you have a little more credibility, but give it to us.
I'll be honest and say that I have in the past, but not in my current job, made the argument against GP stakes. Okay. But that market has changed, and my view has changed as the opportunities have grown. A fundamental argument against GP stakes, of course, is that you have some dilution of the economic interests of the general partner. And if you're backing a group and you rely on, more than anything else, you rely on alignment and incentive to motivate that person, you don't want to see the money going out the door to some stranger. The models that have emerged that address that shortcoming in GP stakes focus on the use of proceeds. Where's that money going? If it's leaking out the door to a retired founder, it's a little bit harder to stomach. From an LP's perspective. If it's being reinvested in the business, if it's allowing a better or different compensation system, better alignment with younger partners, if it's allowing for investment in systems and infrastructure to create a better business, well, LPs can generally get behind that. But it's this dilution of incentive that's the source of tension. From an investor's perspective who has exposure to GP stakes, and I pursued a lot of these transactions when I was at Alaska as a regular way LP, so there's some credibility here. I viewed it as a kind of, if you can't beat them, join them, which is to say that GPs are paid a lot, and fees are painful if you're paying them, but a little less painful if you're getting some of it back. So I thought I'd end up in a better place if we backed the best GPs, maybe owned a little piece of their economics, and then that came back onto our balance sheet eventually, and I could feel maybe a little better about their ultimate success because it was shared success. Shared success is kind of an elusive but worthy goal in private markets.
Sarah.
All right, so I'll be deliberately a little bit provocative here, but understanding that I agree with everything that you say. It all makes sense, and some of it makes better sense on paper than in reality. So what we're really focused on at NEPC, and by the way, I oversee the investment team at NEPC. We're allocating about $8 billion a year to alternatives, to private markets specifically, across 100 funds. So we see a ton of structures, we see a ton of funds, and we have 2,000 meetings a year. We only allocate to 100. We have an investment framework to ensure that we're overcoming bias and not getting sort of whipped around by different marketing discussions. And that we have sort of our true north and our anchor to windward when we're making investment decisions. And a huge part where I believe one of the biggest risks in private markets and hedge fund portfolios today is succession risk. And this is a really big part where I think a lot of LPs maybe gloss over this. So never has there been a larger percentage of founders who are star portfolio managers or making big decisions in the fund. They're approaching retirement age. And if they haven't thought about the next generation and grooming that next generation of talent, and most importantly, handing off the economics. So who's going to buy them out? Because they've made a lot of money since founding that firm 25, 30 years ago. We did an exercise at one of the asset owners that I worked at, and we basically had a framework for looking at succession risk and rank ordering those GPs in order of biggest risk to least. We presented it to the investment committee, and 2 weeks later, the GP at the top of our list, announced they were closing and returning capital so they can just manage their wealth in a family office. But what we look for, and what really is tricky about these partnerships and having a multi-generational partnership, is that buyout. It's really, really hard to get it right, and it's really hard for a founder to agree with that next gen. So number one, we want to see founders who are about to think about exiting or reducing their stake, thinking about this 5 to 10 years in advance, which, by the way, is super hard for people to think about their own mortality or humanity, or that they might ever retire someday. So that's just human nature. And then the other is that, a firm is going to fundamentally change. Its incentives will change. Its alignments of interests are going to change when a new owner comes in. So everything can make sense on paper, but when it comes time for personalities, systems, changes like that, it can be a lot more complicated than it might seem. And the thing that we don't want is for GPs to take their eye off the prize, which is make us money, as opposed to we want you to make money from performance fees, not from management fees and product proliferation and gathering more assets. And we want to keep that team in place. And so we're going to have a big re-underwrite if you take money from the outside. It doesn't mean that it's always bad, but we have this framework that I have my team do is 400 questions, and we're asking every single one of those. So I also, NEPC is a private partnership, and we've been through 2.5 to 3 generational transitions, and we've been able to do it. But I have a front row seat to how difficult it is, and so that also informs how we think about this.
It always bugged me as an LP that there was this small but recurring injustice, which is that the LPs, Mass Prim, Alaska Permanent, and lots of others, were essentially creating value, enterprise value, at these GPs. And people didn't really acknowledge that, or maybe even appreciate it for a long time, until some of these firms went public or started to sell interests. But there was a colossal amount of enterprise value that was created. And it was the founders of those firms, of those GPs, that kept it all in their pockets, and they're billionaires. And I'm happy that the world provides for that. But Mass Prim was making $150 million commitments to some of these firms, and GP stakes even the table just directionally, and that's part of I think the sort of the fundamental moral argument for it. And then there are economic arguments like cash yield, diversification,
they have
access,
cash flow for sure.
So GP stakes is a big mega trend.
Yeah.
What else is a mega trend that you're watching? And Sarah, I listened to a podcast you did, I think, in 2023, and you sort of said that 2023 was going to be, a very difficult fundraise market. You said that there will be a liquidity crisis. You were right. What are you seeing now? What do you think is going to unfold in the next 12 to 24 months?
Okay. So in 2022, I did a podcast. I said, I think we're going to see a reckoning. We saw that in 2023. What I think we're going to see now is that we've heard a lot of talk of liquidity issues, but really when the rubber meets the road, our clients are all able to continue to commit. They might be making some smaller check sizes or reducing their commitment pace a little bit, but public markets being up as much as they are has really masked any potential issues. And so we're doing okay from a liquidity standpoint. A lot of the liquidity that our clients have gotten, especially if they have venture portfolios, is on average a venture GP up until this year had about a third of its portfolio in publicly held stocks. And so those publicly held, recently IPO'd, or maybe a couple of years ago IPO'd securities are the first things that they sold. And so that was a wash of liquidity that is, I think, really pulling forward some liquidity in the system that we normally wouldn't get. So my concern is 2 years out, 3 years out, maybe even 5 years out, what position will we be in? And what will the dead weight risk be in portfolios with things that really, if they could have been sold, they would have been sold? The other is obviously the higher cost of capital. And there is zero margin for error for buyouts, especially to misstep, because it costs 1,000 bips now or 900 bips instead of 500.
Steve, what do you see?
Well, I think Sarah's demonstrated she's better at predicting the future than I am. And I do have a long list of worries, but I'm also excited about the opportunities that emerge inevitably from disruption. A chaotic market creates some additional incentive for new firms to spin out from big firms, And I don't have anything fundamentally against the big firms, but I value them in part because they're kind of nurseries for talented deal teams that then
breeding grounds. Yeah, they're breeding grounds. Yeah,
like factories of for innovation. Because to the extent there's innovation in private markets, and I think there can be a great deal, it's happening with new and emerging managers. It's not. I'm reluctant to say Carlyle, Blackstone, or Apollo or anything like that. But if you consider that ilk of the big funds, that's not where innovation can occur because it doesn't happen immediately at scale. It has to happen in new firms pursuing new strategies, say Whitehorse Liquidity or Arctos. We're talking about sports later. And so
those are two superstar, breakout entrepreneurial firms.
Well, and interesting innovations because they're institutionalizing. They didn't invent sports or invent preferred equity, but they're applying them institutionally in a way that hadn't existed before. And there was obviously a giant latent market that they've tapped. So I don't mean to. I'm not dodging your question about what that sort of next big thing is, but I have a high degree of confidence about where it'll come from, and I think that's from emerging managers. If you're not backing new and emerging managers, this implies there's some significant opportunity cost too. So I'm excited about what.
That's great. So that's a good launch-off question. So 2 biggest concerns on your plate right now and 2 biggest opportunities. Sarah.
Okay. So 2 biggest concerns. One is the valuations at which these portfolio companies are being held. So we do a lot of work at NPC understanding valuation policies, and they can vary extremely widely from one GP to the next and from one time period to the next with the same GP. So we really want to understand how they're pricing these portfolio companies. And a little fun exercise for any LPs in the room, or maybe even for GPs, is take a look at some of the overlapping holdings of your GPs and overlapping portfolio companies and see where they're held. If you're held lower than the last round financing, you're probably in pretty good shape. If you're held at last round financing, you should expect some write-downs. So that's one. And then the other is just limited exits. And then on the opportunity side, this is one of the best times to put your capital to work when it feels really scary. So some concerns with dollars in the ground, but as it relates to new dollars put to work, in most every area, it'll be great, especially early stage venture, so seed, Series A, as well as the more sort of workout situations or special situations where being a debt provider, provided that your GP has really good workout capabilities, can be a great return. I think the fact that cash is yielding is a huge competitive force that LPs are going to make a lot more money in a much safer way, 4.5% to 5% in cash today. And by the way, the pref isn't increasing along with the cash rate. So I think LPs are going to be much more clinical and careful about which GPs they'll commit to in privates.
So 2 biggest concerns, 2 opportunities. You blew one of the opportunities. It's entrepreneurial ventures in the space.
There are more than 2 out there.
Okay, go ahead.
On the negative side of that, on the worries, I have a concern because I believe in the importance of public pensions. I believe in the purpose of those funds and the value of these traditional large investors in private markets. I worry that the number of structural disadvantages they have is increasing. There are all these problems that are kind of easy to identify and super hard to solve, particularly for U.S. public funds. They don't pay their staff enough, or they've got some governance dysfunction. Right. And if that weren't enough, now there's a competitive threat for those big investors, and that is that there's now retail money that could replace them.
Right.
There are public alternatives. There's long-term capital. There's sovereign capital. I work, Wafra is wholly owned by the Kuwaiti Social Security System. There's money coming out of the ground in the Middle East still. And if you're an undifferentiated pension fund that's under-resourced and, possibly today fully or over-allocated to private markets, I would say it looks like you're in a tough position. And having a long-term structural disadvantage in a competitive market is really bad news. So I fret for them. I think the industry's changing, and I think that there'll be winners and losers. And there's got to be a better word than loser here, but I'm going to say that public funds are just disadvantaged. I worry about that.
Well, that's a really interesting perspective. I mean, everyone talks about winners and losers in GP land, but they don't really talk about it in LP land. And that's a really interesting perspective.
I think there's a tendency to think that they're not competing, but there is no resting place in a competitive economy. You have to compete to survive. And they're competing either for the best, if not the best deals, then access to the best
talent
at the best time and the best talent.
Right.
And even if those disadvantages are small, if they're persistent, it leads to really bad outcomes. Just as great ideas compound over time and create great value, structural disadvantages compound over time and drag you into the basement, which is that's almost a double downer.
Double downer. I like it. That's the other headline we're going to leave the stage with. So because we have two very rare and talented people up here who have both been on the LP and the GP side, I'd like to ask you both, what was the big surprise from one side to the other? And because this is about the LP-GP relationship, what can people learn about your experience when you had your aha moments? Sarah, you can go.
I'll start. I've had a version of this surprise twice in life. When I switched from investment banking to private equity, I thought before day one, I thought I kind of understood it because I'd worked on some deals with sponsors, and then the actual change is much greater than you think. The deal, and if you're a banker, the deal's done the day you sign it up. Maybe you have to worry about deal toy or a closing dinner, but the work starts for private equity. And it took me a while to learn that lesson because I'm kind of a slow learner. And in that switch from being a GP to an LP for years, I learned an awful lot. That learning resulted in sympathy, and I guess I'll just give you an anecdote.
Yeah.
I thought before moving over to LP land that there were several things that I could do better as an LP than I saw other LPs doing. And one of those was that I intended to be, and was initially, for an embarrassingly short period of time, super responsive. A GP would call an idea, and I'd get right back to them. And I even had this rule that we'd always respond within 24 hours. And that worked really well for about a week, because nobody heard of Alaska and there weren't that many calls. There wasn't a lot of incoming.
No one's calling Alaska.
But after about 2 weeks, I had to kind of extend from 24 hours to 48 hours. And then seemingly suddenly, there was this sort of flood. And it is the case, I think, for most LPs that they're just, vastly outnumbered. This would be true certainly of public funds anyway, because of the resource issue that I referred to. Vastly outnumbered by some highly incentivized marketing people and others. So eventually, the 24-hour response turned to 48, then 72, then it was sort of weeks, and then I got to the point where I was sort of like, I can't read all these emails. I don't know what's going on. And then I became one of the people, and I still am guilty of this today, hopefully to a slightly lesser degree. I became one of the people who just, couldn't respond. And then I'd bump into somebody at a conference like this, and they'd be like, can't you read? Didn't you get that message? So it's made me much more sympathetic, and I use that example because it highlights the difference between well-resourced GP land and chronically under-resourced LP life.
That was a great example. Sarah.
Yeah, so I think, the first thing is that when I went from the GP side to the LP side in 2011, people scratched their heads. They said, what are you thinking? You're just going to be pushing papers. You're going to be working it's just an administrative role. And at that time, it's hard to believe, but the LP side, especially public funds, we were not considered investors in the ecosystem. There's been a massive shift in terms of really, really talented people being drawn to the mission, the purpose, and the lifestyle of being an allocator and just the intellectual horsepower that's required. It's a really fun job. But at the time, nobody really understood it. And I kind of just knew that it's what I needed to do. It was a leap of faith, and then it ended up working out great. The other thing I didn't understand is that, there is a tremendous amount of governance skill required to be an LP. So you have to manage a committee. And the committee is probably going to be pretty well versed and full of experts who are really going to grill you and be tough. But they might have certain areas of expertise. One person might be a quant. One might be only private real estate. One might be a big donor who has a real bias against non-U.S. equities. And so you have these battles about do we lose this donor or do we divest from anything non-U.S. equity related? It's super complicated. And then you have a board, which may be composed of people like state troopers or retired teachers. And you need to be able to speak at multiple different levels of granularity. So you need to be able to know your stuff with the experts and then describe it. I mean, it's almost like, I've been presenting to kids a lot lately about investing, and they're almost like the hardest people to present to because you can't use the lingo and the acronyms. And so learning all different ways of presenting material so that the stakeholders and the decision makers will understand is really important. when I went from a public pension fund to an endowment, we went from having 18,000 line items of data that we could and did measure on a daily basis, separately managed accounts. Most of our portfolio in publicly traded stocks, or securities, like 2/3 of it, to an endowment that was flipped on its head. No data, 2/3 in alternatives. And it went from being a data-driven approach, which we had to do in a public pension because we were subject to Freedom of Information Act and had to defend our decisions, to going to an endowment where we really didn't have any data. And so the critical thinking skills required when you have a big alternatives portfolio, I'll never forget one of the people at the endowment said, I'm extremely comfortable with ambiguity. Plus or minus 2% in China, it doesn't really matter. What are you going to do about it? So I've really learned the value of the question, so what? Is there value in this data and having something to the basis points, or is that false confidence? And so the critical thinking skills required. And I think and then as you get more senior in these organizations and closer to a CIO type of role, you realize that very little of your jobs actually focus on investing, probably 15 to 20%.
Yeah, that's great. So we're almost at the close. I wanted to ask you, Sarah, about your children's book.
Oh, yeah.
If you can tell us a little bit about that.
Thank you. So I wrote a children's book called Braving Our Savings, and it was released last month. And the goal is to give it away to kids from underrepresented groups because there's not a lot of diversity in our industry. But also I came up this industry as an admin and think every kid should have the opportunity to have that career trajectory. And they just really need to be shown. And so I've been teaching kids and giving it away and have great partnerships in the asset management community. I also got divorced 4 years ago, told Steve about this, and taught my 2 girls who were 6 and 9 at the time how to invest because I said, over my dead body, will they not be able to take care of themselves financially if they ever need to? Thought it would be easy to explain. It absolutely was not easy to explain. And so I decided to write a few things down. But we've had great endorsers from the pro sports community, from NASDAQ, from, really great people like Ted.
Yeah.
And it's been in this sort of trifecta of a really powerful group promoting this message that every kid can invest. And you should see these kids. They're like 7 and they get it. They're asking better questions than I would.
That's so great. So I want to ask you both, how do you want to be remembered as an investor when you think about your careers? You've both been in such storied careers on the institutional investing side. How do you want to be remembered?
That is an excellent question. That would be an even better question if you could follow up years and say, hey, do you like the way it's said? But anyway, the part of our industry to which I attach the most value is the new stuff, the new ideas, innovation. And I recognize that, as I think you said, Jen, innovation and asset management are rarely contained in the same sentence. It is actually the case that in asset management, because we're talking about soft assets, about people, about numbers, about spreadsheets, things can change quickly. You don't need to remachine a giant factory in East Lansing to make changes. The opportunity exists for innovation. The incentives are clearly there. And I've found that you have a lot of creative, highly energetic personalities. And, let's face it, a sort of 2 and 20 economics attracts a lot of talent to the industry. Assets the world would be better if they were going to med school or something else, but they're attracted to our industry. So great people, great talent, great assets creates this very fertile environment for innovation. And I want and hope to continue to be part of that innovation.
Cool. Sarah.
Yeah, it's a great question. You're kind of asking about legacy. And for me, I don't really think too much about my legacy because I think it's a bit... It's a more egocentric than I prefer to behave. But what I do know is that I really hope that in 10 years, 15 years, 20 years, whenever I retire, the power of capital and the purpose of our capital is front of mind for everybody in this industry. And so every one of you in this room is a steward of capital. Every one of you is at the helm of really big decisions that make this world go around. And what we're doing is incredibly important, and it touches people's everyday lives, and it funds innovation, by the way. I mean, venture, entrepreneurs, can't do it without our industry. So really just remembering that it's about much more than just us. We can be successful, but we can also do a tremendous amount of good and lift others up. That's what I hope.
That's great. We have 10 seconds. I'm going to ask my favorite last question. It's called Check This Out. Something that you're obsessed with that you're telling everyone to check out. It can be anything. It can be an app, a show, an article. check this out. Who wants to go first?
The Counting House. It's a great book about being an allocator.
Oh, great.
My favorite new app is an app called Peak Finder, which you New Yorkers will find completely irrelevant. But as soon as you step outside of New York, it's an AR technology with colossal amount of data behind it, and you can just sort of move around the landscape, and it'll tell you about every peak, every hill. If you're in a place like Alaska, it's breathtaking. If you're in a place like New York, you'll discover you actually live on kind of a flat lump of land. But the app is Peak Finder.
Peak Finder. All right. Thank you very much. Well, thanks everyone.